Welcome to My Game is Money Investing with your host, Mr. G, the retail trader. Today's episode number 8 is intrinsic value versus market value. We found an article in Investopedia Team and dated back November 2nd, 2019. It's a little outdated, but still holds value. So I'll just read the article and that'll wrap up today's video. Intrinsic value versus market value. An overview. If the stock has a significant lower intrinsic value than its current market price, it looks like the red flag that the stock is overvalued. But that's not necessarily the case. The disparities between intrinsic value and market price is known in the investment world as price to book ratio. Price is the current value of the stock as is set by the market. Book value is the stock's intrinsic value. It is the amount a shareholder would receive or be entitled to receive in theory if the company was liquidated. The market price of a stock is almost never the same as its book value. Market value. Market value is determined by supply and demand. The price of the stock reflects the current demand for it. If there is a strong demand from investors for a particular stock, its market price will rise above its book value. Here are 3 key takeaways. Market value is the current price of the company's stocks. Intrinsic value is the sum of all the company's assets minus its liabilities. The price to book ratio is just one factor to look at in deciding whether a stock is overvalued or undervalued. Although a stock may appear to be overvalued, at least temporarily, that does not mean that it should not be purchased or at least considered. Overvaluation and undervaluation are everyday occurrences. The goal for an investor is to buy low and sell high. If an investor believes that a stock can very likely be sold in the future for a higher price than its current market price, it may well be an excellent investment, regardless of the company's current intrinsic valuation. Jumping into intrinsic value. Intrinsic value or book value is a company's total assets minus its total liabilities. That seems like a fair, straightforward calculation. A company may own a headquarter buildings, a theme park, or a casino. It probably has borrowed a certain amount of money as well. Here's an important tidbit. Intrinsic value is not an entirely reliable number or, for that matter, a stable one. But what are the patents or its copyrights worth, for example, or its intangible assets like goodwill or brand recognition? Traders are mindful that the book value is not a complete, reliable number or, for that matter, a stable one. One hot scandal can destroy a lot of goodwill or brand recognition. The value of a company's physical assets can change with the economy, with the consumer taste, or with time. Here are a couple special considerations. The price to book ratio is just one measure of equity valuation. Analysts commonly examine a company and its stock price from several angles in an effort to get the most accurate assessment of its genuine value. A good complementary valuation measures the price to book comparison is the return on equity, ROE ratio. It is an indication of how efficient a company is using its shareholders' equity to generate additional profits. So this wraps up episode number 8. Of course, as I always mention, I'm not a financial advisor and these videos are for entertainment purposes only. Please hit the like, subscribe, hit the bell notification if you enjoyed the video, and of course leave a comment. Again, thank you for all your support and I appreciate you, and hopefully you visit me on the next video. Have a good day.